Have you ever wondered what one of the most powerful yet kinda overlooked secrets to long-term wealth really is? Well, today we're diving right into it. Dividend growth investing. Now, I know it might not have the flash of the next hot tech stock, but believe me, it has something way more valuable, a seriously potent engine for your portfolio.
Just look at this number for a second. 85%. What on earth is that? It's a pretty staggering statistic, actually. Since 1960, 85% of the S&P 500's total return didn't come from stock prices just going up. Nope. It came from something much, much quieter, reinvesting dividends and the compounding growth they created. Just let that sink in. The huge majority of the market's returns came from this one single source. So that leads us right to the big question, right? What is the real power behind that seemingly small dividend check? Because it's a whole lot more than just some pocket money. In this explainer, we are going to unpack exactly how these regular payouts can become maybe the most formidable growth engine in your entire investment strategy. Okay, first up, let's talk about the unseen engine of growth. We're going to unpack the almost magical force of compounding. This is where the true power of dividends really gets unleashed. So, what exactly is dividend compounding? You know what? Think of it like a snowball rolling downhill. Your first investment, that's the small snowball. The dividends it pays out, that's like the new layer of snow it picks up every time it turns. Now, when you reinvest those dividends, you're just buying more shares. Your snowball gets bigger. And now, that bigger snowball picks up even more snow on its next roll. You see where this is going? Over decades, that tiny snowball can become an absolutely unstoppable avalanche of wealth. And this chart, wow, it just shows that effect so brilliantly over time. Let's say you invested 10 grand in the S&P 500 back in 1960. That blue line, that's just price growth. But the orange line, that's your total return with all the dividends put back to work. Look at how in the 80s, that gap really starts to open up. But get this, look closer at the 2000s, the so-called lost decade. Stock prices went absolutely nowhere, but the dividend portfolio, it just kept chugging along, growing quietly. For a dividend investor, that wasn't a lost decade at all. It was a chance to buy more shares for cheap. By the time we get to 2023, the difference isn't just a gap anymore, it's a chasm.
And here it is again, that 85% number. But this time, you can really see it. This chart just lays out how much of the heavy lifting was done by those dividends and their compounding effect. You know, while so many investors were obsessing over daily price movements, that tiny little 15% sliver, the real long-term story was being written by those reinvested payouts. It's like the silent partner doing most of the work. Okay, so now that we've seen the incredible growth potential, let's switch gears and see how dividends also act as your portfolio's financial bedrock. It's this awesome combination of income, stability, and a really crucial layer of protection. So think about it. How do you actually get cash from your portfolio? There are really only two ways. You can sell some of your stocks for a capital gain, which, is unpredictable and forces you to try and time the market. Good luck with that. Or you can receive dividend income. The difference here is just night and day. Dividends are predictable. They're paid on a regular schedule, and they're sustainable. You get cash without having to sell off pieces of your precious asset base. And that is so important, especially when the market is down. Now, this chart, honestly, this is a game changer. It compares the performance of companies that consistently grew their dividends against companies that paid no dividends at all the way from 1973 to 2024. Not only did the dividend growers deliver more than double the annual returns, but they did it with way less volatility. Higher returns with lower risk. I mean, for a lot of investors, that is the holy grail. And this quote just sums up that protective power perfectly. When stock prices are falling or maybe just treading water, that dividend check keeps showing up. It gives you a positive return stream at the exact moment you need it most, and it acts as a really crucial buffer against all that market chaos. So, we've seen how dividends provide stability, but they do something else, something that's almost like a secret decoder ring for finding great companies. A dividend isn't just about the money, it's a powerful signal about the quality of the company itself. Let's dig into how these payouts can reveal a company's true financial health. I mean, think about it for a sec. A company that can consistently pay and even better, grow its dividend is sending a really clear message. It's signaling that it has strong, reliable cash flows and a business model that's built to last. It shows you that the management team is disciplined and feels confident about the future. This whole thing acts as a quality filter, helping you sidestep those so-called value traps. Stocks that look cheap, but they're cheap for a reason, because their business is actually falling apart. And the data totally backs this up. This number, 70%, that's the percentage of time that companies with moderate, sustainable dividend yields, and I'm not talking about the highest, most risky ones, outperformed the S&P 500 between 1930 and 2024. So the key takeaway here isn't to just chase the highest yield you can find, it's to look for a healthy, sustainable dividend as a powerful clue that you found a quality, long-term performer. All right, let's zoom out a little bit. Because of all these qualities we've talked about, a dividend strategy isn't just for sunny days. It is an all-weather investing tool. It can act as a fantastic hedge against both inflation and just general uncertainty. So how do they adapt? Well, first, they're a powerful hedge against inflation. Healthy companies often raise their dividend payouts faster than the rate of inflation, which protects your income stream's purchasing power. They also give you crucial diversification, balancing out those high-flying, volatile growth stocks with more stable sectors. And in times of rising interest rates, a solid dividend yield becomes a really attractive alternative to bonds. It's just flexible. Okay, we've covered the why. Now let's get to the how. This next part is all about putting dividends to work for you, to build a more robust and resilient portfolio. So where do you even start? Well, a really common framework that lots of investors use is to allocate somewhere between, say, 20 to 50% of their stock portfolio to dividend-paying assets. That could be individual stocks, ETFs, whatever works for you. Of course, this isn't some hard and fast rule, but it gives you a tangible starting point for thinking about how to weave this strategy into your own investing. So, to bring this all home, here's a simple 4-step guide to building your strategy. First, and this is key, assess your own goals and your timeline. Are you saving for retirement in 30 years, or do you need income a little sooner? Second, based on that, make a deliberate allocation to dividend assets that actually fits those goals. Third, and you knew this was coming, this is the most important part, make absolutely sure you are reinvesting those dividends to unleash the full, unstoppable power of compounding we talked about earlier. And finally, just always be mindful of the tax implications, especially if you're investing outside of a retirement account. And that brings us to our final thought. As you look at your own investments, I want you to ask yourself this one question. Is your portfolio built just to grow, or is it truly built to last? By bringing in the income, the stability, and that incredible compounding power of dividends, you're not just chasing returns. You're building a resilient foundation for all the decades to come. Thanks for joining us for this explainer.